Yeah, we'll do all the questions at once. I think it'll flow smoother that way, yeah. Just before I introduce John, just one bit remiss of me earlier on. The gentleman on my right here is Richard Wraith, Councillor Richard Wraith from Barnes, who's the Vice Chair of the Authority. I omitted to introduce him at the start. Sorry about that, Richard. John Hattersley, I think, is equally well known to everybody as Dave, and I think John's been giving this style of presentation to you at AGMs for as long as I can remember. Anyway, I think managing a fund isn't the easiest job in the world, and hasn't been for the last few years. And I think and the South Yorkshire Fund is one of the biggest. It's one of the biggest local government funds, and I think it's also unusual in that John and his small team at Barnsley manage the vast majority of those funds hands-on in-house, rather than, as most funds do, contract it out to specialist managers. So I think John's going to give you a run-through on the investment world, some of the things that's been happening, and and how the fund has performed over the last year. So John, over to you. Yes.
Good evening, everybody. I've been accused of being grumpy and worried tonight. I'm normally grumpy and worried, so don't take any slight. It's just part of the job. I'm going to follow on from what David and Andrew Sanger have mentioned, the big themes we're facing in the world of pensions. And I thought I'd make it slightly more interesting than the normal boring spiel and ask you this question. We've been talking about longevity, how long people live. Would you please guess, and I'll ask for a show of hands at the end of my little chat, when was the last American Civil War pension paid? Now, American Civil War was 1861 to 1865. So when do you think the last American Civil War pension was paid? 1894. So I'll ask you that at the end of the presentation. Statement of accounts. You've seen this year in, year out. Same basic format. What the slide shows, in essence, is that contributions rose last year, just over 12 million, but the bulk of that came from the employers. Worryingly, perhaps, the amount of income coming in fell by nearly 19 million. Now, the bulk of that loss came from our reduced income from bonds and the fall in interest rates on cash. Bond income fell by some 9 million, and the interest on cash fell by 6 million. Obviously, you've all lived through the last 2 years, so you're all aware of the financial constraints we've been facing. We're not immune from those. We have to adapt to those, but we're not immune from them. Taken together, contribution and investment income broadly stable, brought in some £342 million last year. However, reflecting the maturity of the fund, monies paid out in benefits rose substantially. Overall expenditure increased by some 23 million at a time when our administration costs actually fell. So the result was that the money available for investment over the period fell from 159 million to 133 million. Now, as Dave has mentioned, that doesn't mean the fund is bankrupt. The fund remains cash positive. It's just that last year, one or two things started to change shape. The Hutton report shows that on present estimates, local authority pension funds will remain cash positive until at least 2025. That is on present measures. There are one or two individual employers, however, who are not in that position. And indeed, last year, one of our big four employers found itself in a position where we actually paid out more in terms of benefits to its employees and contributors than we actually received from it in terms of contributions. That is not unexpected. It just reflects the growing maturity of the fund. Now, the good news last year is that the value of the funds recovered. Those of you who suffered my presentation last time heard what a really tremendous year. Well, no, it wasn't. It was a horrible year. 2008, 2009 was a really awful year in investment terms. You can see from that slide how the fund value fell from 3.7 billion to 3 billion. Well, this year it bounced back. We finished the year at the 31st of March, valued just over £4 billion. It was an extraordinary year in investment terms. According to the independent consultants, the WM company, it was the best return that local authority funds had enjoyed for 30 years. Equity markets recovered strongly, particularly those known as the emerging markets and the Pacific Rim countries. They produced returns of over 60%, whilst the US and Europe slightly lagged, but they still produced returns in excess of 40%. In terms of overseas markets, the worst performer, Japan, produced a return of about 33%. That's adjusted for sterling. Those of you who've been to meetings before have always heard me explain how difficult it is to compare funds with each other these days. We all have our own different liability profiles. We have different employers with different employment policies, different services, different ages of employees. And I've said before, and it's also mentioned so far tonight, that the fund is relatively mature. I don't want to over-egg that, but it is relatively mature. And because of that and the need to secure investment income for our pension payments, we invest in bonds, because bonds are the safest of the asset classes. One of the problems of investing in bonds, though, because they are safe, is your returns tend to be relatively low. As Andrew Sanger mentioned in his introduction, investment is about risk and reward. If you don't take the risk, you don't get the reward. But you don't want to put all your eggs in one basket. So it's a mixture of assets we invest in. The least dangerous, i.e. the most safe assets, are government bonds. And we have a lot of those. But unfortunately, they tend to return relatively weak returns. And you can see from this slide how we differ from the local authority average, particularly looking at bonds. Last year, the average fund had 17%. We had 23%. In equities, that is company shares, which are the aggressive side, they're the least safe part. The average fund had 66 and we had 58. Now, if you just cast your mind back to the previous slide, where we had a year of bumper equity returns, obviously those proportions were not favourable to our fund performance, because we had more in the safe underperforming assets than we had in the equity markets. So what did we do last year? Well, actually the fund returned 31.6%, which is a good absolute number, but I'm afraid to say it was below the local authority average, largely because of those numbers I've just shown you. The local authority average is 35.2. Now, one of the questions I was asked before, one of the pre-meeting questions we received, was why didn't we do as well as our peer group? Well, the previous slide answers that to a degree. The mixture of each fund differs. If you've got a fund with a lot of young employees, recently recruited employees, you are going to take a different investment profile. You're going to have more people for longer, therefore you can afford to invest in equities, because equities are volatile. They're risky. If you're in a fund which is close to everybody retiring 2 or 3 years before retiring, or 2 or 3 years before the fund closes, you want all your assets in the most safe form of investment, in bonds. So you cannot compare one fund to another. I'm not making excuses about our performance last year. It was not that good. But it was not good for what I think was the right reasons. We were ultra cautious last year. The first 2 quarters of the first 2 quarters of last financial year, we had concerns about the strength of the recovery. And because our primary purpose is to preserve capital, we held more in cash than we should have done. We therefore lost out. The last 2 quarters, where we were more confident about markets, we actually outperformed, but we didn't outperform enough to recover the underperformance of the first 2 quarters. This slide shows how the fund was actually positioned at the end of March relative to its benchmark. You will see, although we had more in bonds than the average fund, we didn't really like bonds that much because we knew the markets were going gung-ho for equities. So we actually had an underweighting position in bonds. That's fixed interest. That is the big line going down. We did have a relatively large amount in cash still at the year end, just over 2%. We had less in property because property prices were falling. We had more in equities, both international and UK. In one of the regular meetings we have with trade unions, they said, we'd like to know a bit more about your property portfolio. So I'm going to talk about that in a bit more detail later on. But this is another way of showing how the fund was allocated at the end of the year. You'll see that in equities we had 58%, split roughly 50-50 between UK and overseas. Similarly, within bonds, we had a split of roughly 50% in other fixed interest, which is primarily corporate bonds in our case, and roughly 50% in index-linked gilts. Now, index-linked gilts are the safest of the safe, but if you buy a 50-year index-linked gilt now, your real return is 0.6%. 0.6%. That's not a very attractive price if you're investing for a 50-year period. It is, however, safe, as long as the UK doesn't go bust. So we do have some of those, but that goes back to the earlier slide and partly explains why we're underweight bonds against our allocation, but you'll hopefully appreciate how in a year when equities outperform bonds, it hurt our performance. Property, just under 9% there, because this is our direct property portfolio. Private equity, 5.5%, absolute return, 2.7%, and there is the allocation to cash at 2.4%.